Hi, Tom and Scott take up building a core satellite options portfolio, overnight resting futures orders, quitting your day job to trade, your calls, and we end with a look at today's markets. Our first letter comes from Akram, who asks, if you had to build a simple rules-based core plus options satellite portfolio for the next 3 to 5 years, what would you put in the core and what would you sell options on in the satellite portion and why?
First of all, I love the question, Akram, because if you had to build a simple rules-based core plus option satellite portfolio, that in itself is kind of a mouthful. But I've been talking about for people, I think we kind of introduced for active/passive traders the term kind of core portfolio over the years, because I think like most people always thought their passive portfolio was kind of their core portfolio. But what we wanted people to do was to take that core, these stocks that you love or whatever it is, and learn how to improve your basis. So one of the things we're doing with One Lucky Dog that rolls into our Lossdog software is we are going to show people using our new technology exactly how to kind of rate your ability to optimize your core portfolio. So it's almost exactly what Akram's asking us here, but not knowing, you don't even know what we're building, and it does exactly kind of what you're saying. But
maybe there's an insider that's giving a leak.
Yeah, maybe. But
who could that be?
I can't tell you what you would put in your core, because that's really up to you. Like my core portfolio would differ from Scott's. Scott's would differ from Sol's, and so on and so on and so on. Some people, they want to be all in on tech stocks, or they want to be all in on, even taking it down another notch. You want to be all in on AI stocks, or I don't know. Some people want safer things like utilities. Other people want, small cap stocks because they think they've underperformed. Some people, like, I go through these stages where all I want is like Chinese stocks for some crazy reason, or debt related stocks. So all I'm saying is I can't tell you what you should put in your core, but I can tell you that in order to make up the most capital efficient and logical approach to building a core portfolio, you want to write calls against your longs, and you also want to substitute some of your longs with some short puts to give you a higher probability of improving your basis on everything. Because the key to a really successful core portfolio is always lowering your basis, and just getting dividends is not enough to just lower your basis.
It helps.
It helps, sure, but it's not enough. It's a natural way. It's very organic, just to get dividends to lower your basis, but that's not strategic, and we want people to be strategic. So all I would say, Akram, is learn how to, find the right delta call to sell, find the right delta put to sell, add that to your strategy inside of your core, but you have to pick your core.
There you go.
Agree.
All right, great question. Thanks, Akram. Next up, how much trading capital were you using when you were trading to support your family at 25 and 30?
25 and 30
years old.
I didn't have a family at 25 to 30, but it's not. That's not a fair question for us to answer, because the reason being we were market makers on the floor. The CBOE we were trading in the S&P, the OEX, the S&P 100. And the reason I say it's not a fair question is because market makers, we got relief. So we were able, our role was very different. What we were doing back then was very different than what we're doing now, which is the same thing you're doing, is trading as retail. So the amount of capital that we needed was significantly lower.
So I'll tell you a story. Mm-hmm. So when I first decided to come to Chicago, well, I didn't decide. I was living in New York, and I was working on Wall Street, and somebody said, and all these guys were married, and they said, hey, if you want to move to Chicago, and I didn't even know where Chicago really was.
Oh my.
I mean, like, I'm just telling you, but like when you grow up in New York, you really do think
Yeah, I know. It's like,
that the
oh.
world
Everything,
ends.
it's New York and everything else.
Is
Right.
the only
You-
city that can be called the city
There-
is
it
New
It is-
York.
It is the city.
so annoying.
regardless
It
of
is
where
annoying.
you are
I
in
agree.
the world,
But-
it's the city.
But there's a New
Yeah.
Yorker cartoon that shows kind of New York City ending at the end of the East River, and then the rest of the world, like you don't even know it's there.
Nothing, yeah.
And obviously
Cornfields.
I'd never been to Chicago. I don't even know if I'd ever been to the Midwest. And somebody said, if you move to Chicago, we'll put up the money. So I flew out to Chicago and just to check it out. And I loved the city when I got here, but then because I took a drive up Lakeshore Drive in a cab, and it was really beautiful.
Nice, yeah.
But then I went to the exchange floor. As soon as I got on the exchange floor, I'm like, oh my God, this is the greatest place in the world. Like, there's nothing else like it.
Yeah.
And so I went back and talked to these guys that wanted to put the money, and their number was, and I was probably 23, 24, and the number they put up was $50,000. Now, this was for me to trade with and them to trade with.
But this is in 1980.
81.
Yeah.
And they lost the $50,000 2 weeks after I got to Chicago. So they lost 100% of it. I was up $18.75 trading. Because I remember this like it was yesterday.
Well, yeah.
I was up $18.75, and they lost 3 teenies. And they lost the whole 50 grand, everything. And so I got yanked out of the pit by the clearing firm because they're like, hey, your money's gone. And I'm like, ugh. And I didn't have any money. So I met this guy, and just to answer this guy's question, some guy who I did not know, but this was Chicago in the 80s, and it was crazy, lent me $100,000.
Wow.
Yeah. And my original split was 60-40, 60% for me, 40% for him. And as I made more money, it went to 80-20. And then after, I think, 18 months, I bought him out. Gave him all his money, his
Wow.
original money, all his other money, and then I had like 100 grand or
So-
200 grand on my own.
Today, what do you think 100,000 would be?
Well,
Like,
on the
what's
trading
the
floor,
equivalent?
well, the problem is on the
For
trading floor
someone to-
today, there is no trading floor today.
Well, right.
And
I mean,
and
there is, but it's groups.
Yeah.
There's like maybe there might be one local left.
I mean, there are really it's only like the S&Ps, the SPX right now, and those are huge trades. You need a lot of money. So, but trading capital, I would say right now, if you're starting and you really want to trade full time and you want to do this and support your family, you have to think about this. Like, just think about it logically. Okay, first of all, you're going to need portfolio margin, so you're going to need plus 150,000, and then you're going to need, let's just say you need, I'll just make up a number. You need $80,000 to live on, okay? Just because that's what you want to make minimum. Well, if you're thinking about like what's a decent return, all right? You know, if you made a 40% return on $200,000, that's $80,000. So, and that's you got to be good. You know, that's over 3% a month. You know, it's almost almost 3.5% a month. So you've got to be, you've got to get yourself to the point where you're thinking portfolio margin 200 grand right now.
So production team says 100,000 in 1980 is 390,000 today.
Yeah, but it's not because
it's a lot different because
Yeah.
we're a market maker. We had different.
we had
margin
no
requirements.
capital requirements during the
Well,
day.
of course. Of
Yeah,
course.
yeah.
So I could do whatever. I could take $100 million in risk during the day. I mean, they would have thrown me in jail,
Yeah,
but they had no
yeah.
way to control me.
Yeah.
Right.
Well, if they got to it and they saw it, you could get yanked out of the pit. But
Did anyone that you
Oh, yeah.
remember?
Actually,
yanked out of the pit?
without
Yes.
naming names, I will tell you
Oh,
a story of a
Somebody
friend
you
of mine.
know?
Oh yeah, really good friend of mine, still to this day.
Oh,
But I had a friend, we were about the same age, and he was trading in the S&P 100 pit. And one day, he sold 4,000 deep in the money puts. And not deep in the money, but they were just slightly in the money because he was bullish. And
What could go wrong?
What could go wrong? He sold 4,000 puts. And I was standing next to him. I'm like, what the F are you doing? He's like, I don't know. I just got carried away. And I'm like, carried away? Carried away is 200 or 300. 4,000 is like, you've
reckless.
lost your mind.
yeah.
he got them all back, and he made small, like in eighths and quarters. Okay, at the end of the day, those puts were $10 higher. Okay, it was a 40.
Just so you know, that's $4 million.
Is it 4 million or 40 million?
No, 4,000 is 4,000. Oh, 400,000 is 4 million.
4 million, right?
Yeah, $4 million.
Yeah, but I
So-
mean, at that point, he walked out of the pit and never came back.
He never came
And I
back.
guarantee you, whoever this person is didn't have $4 million in their account.
No, he didn't
Oh,
have
of
4
course
million.
not.
God, I thought it was more than 4 million. It was the number was bigger than 4 million. Then on my numbers, then my memory's wrong. But I guess my point is, after that day, he realized he's really smart, and he realized something just
Like, I
broke.
can't do this.
Something
Yeah.
just broke in my head.
Yeah.
Like I
shouldn't
didn't
be
even-
doing this.
I shouldn't be doing this.
Yeah, yeah.
And he went off
Smart.
and went skiing and for like 2 months and never came back.
Wow.
Well, you know, it's interesting because when we started Thinkorswim, we were clearing through a clearing firm that now is owned by somebody else. It's different. It's called Penson. It's now Apex,
Yes.
which is tasty. But they let us because they didn't understand options. Like we were so new to them. They're like, we don't even really understand what this is. And we would just send drop files at the end of the day. So they were blind us. Now we had front end risk margin requirements. So we would block customers from making, so somebody couldn't do
Yeah,
that.
this is like we're doing all this stuff before there was even real risk systems.
Wow.
Like it's
Yeah.
crazy.
Yeah.
Yeah, I mean,
Crazy.
all this stuff is, and the nuttiest thing about all this stuff is like you go through such, like one of the firms, when Scott's right, when we were building Thinkorswim, we wanted to, originally, we didn't have a firm that would clear us. And so we went to, like, one of the firms we went to was Bear Stearns. And Bear Stearns laughed at us. They're like, come back to us when you're a real firm. I'm like,
Yeah.
How's
Bear Stearns
laughing
doing?
now?
yeah,
How's
8 years
Bear
later,
doing
they're
today?
out of business because they can't manage risk. The one firm that would clear us was this one firm in Texas who said to us, "Listen, we want your business," and we're like, "Well, you got it because you're the only firm that wants our business." But it turns out we put them on the map and helped them. We helped them at one point become, raise $25 million and become, a multi-$100 million company. Later on, they lost it all, but that was their own fault.
That wasn't us. That was
wasn't
bad
us.
risk management on their part.
We put them on the map and turned them into, what today is a multi-billion-dollar firm.
Yep.
Anyway, good
There
questions.
you go.
Yeah.
Good questions. Remember to like our video, subscribe to our channel, call us at 989-LOST-DOG, and send us your questions on the dog pound or via email. All right, next up on emails. Do you ever leave resting futures orders in overnight? Are they only to close, or would you ever leave a new buy or sell to open order in after hours?
So I'll go here. My answer, it's kind of a split answer here. While I'm sleeping, it's only to close. I might have something in to close a position while I'm sleeping. But before I go to bed, from when the market opens, 5 o'clock Central, if I'm out and I'm like, like last night I didn't cover a couple SPUs. I was short a couple of yes. I didn't cover them at the bell, and I just put bids in afterwards. But again, that was to close. And, I did get, I was filled. But I won't put anything to open while I'm sleeping because I have no idea what's happening. I'm like,
Yeah.
I don't know. What do I want to buy or sell something when it could be dramatically higher or lower? So
Right.
I want to be aware of what's going on. I like to look at the screen. But yes, absolutely. We'll put stuff in, just resting bids below, or above, depending on what I have, if I'm long or short, and just say, yeah, I'm happy if I get filled while I'm sleeping.
I'm a junkie, and I'm not a
Not a good junkie.
and not a good
Yeah.
a good kind of junkie. But I'm going to agree with Scott. Occasionally I'll put an opening order in, but not really. Almost all my overnight orders, resting orders, especially when I'm trying to sleep, are all to close.
Yeah.
Almost everything is to close. There's a big difference between when you hear the fill, like your phone goes off or your computer goes off, and you hear the ding or the fill in the middle of the night. When it's a closing order, it's a good feeling. You're like, you just go
It's
right.
a really bad feeling when you hear the ding. You're going, oh no, I didn't want to get
no.
filled on that.
When you have an opening order in and you get filled, you don't want to get filled. It's like we had this old thing we used to say, cancel if close, right?
That was
Yeah.
an order
Yeah.
type.
That's an order type. Cancel if close. Like I really want to sell S&Ps if they get to 7,000. Where are S&Ps now? Right at 7,000, right? Yeah.
Yeah, 69.92.
Yeah,
I'm at 7,000. I can't imagine.
Yeah.
I'm gonna,
I really want to
I'll
sell them at
as many as I can
7,000.
sell.
They're trading 92. I want it 69.92. I want to sell them at 7,000. But if they get to 7,000 when I'm sleeping, I don't want to sell them. So cancel if close. But
That's a
But-
great order type.
But I really, if I sold them at 7,000, I really want to buy back at 92. And so that's a good fill. So when I'm sleeping and I'm only have closing orders in, and I hear the ding, it's great. If you have the other kind of orders in, like to open, you're like, no, it's not good.
Yeah.
Okay. All right.
Yeah.
Well, that was a good answer. I have never heard the actual steps on how to replicate a leveraged ETF position, only that I should somehow use futures to do it. Can I buy a far-dated S&P future and hold it for like a year or so and let that settle to cash and then repeat?
That's a little bit, yeah,
It's a little wonky.
wonky. Go ahead, Scott.
I'm not sure what they're trying to do because it depends obviously on the leverage ETF.
I will
Now,
explain what they're trying to do because I actually
Go ahead.
answered this person.
Okay.
Because I am an email junkie too. So that's
Now we are again.
That's the only. Those are
Back to being email junkies.
those are my hobbies. Okay, my hobbies are answering emails 24/7 or trading. That's it. That's all I have. I got nothing else.
Yeah.
Flowers on the weekend.
Yeah, but it's tough in the winter. Anyway, so this person wrote and said, "Hey, I was listening to your show because we have to chop down the questions a little bit. I was listening to your show about leveraged ETFs versus futures, and you guys said you like futures, but I like trading leveraged ETFs. How would I convert my leveraged ETF into a future?" So he actually asked me about a specific leverage ETF. I think it was SSO, which, if I am correct, that is a bullish. Can you just check, Scott, real fast? I think it's
It is
a bullish.
2 times. It's an ultra S&P 500 2 times.
Right. So it's a 2 times S&P ultra bullish leveraged ETF to the upside.
Wow.
And so what I did.
Hell yeah.
That's right. So what I did was, and it's like a $65 stock, right?
59.76.
All right,
yeah.
$60. So it's like a $60 stock. So
It's been from 30 to 60 this year.
okay.
The range in the
So-
last year.
So he said, "How would I like equate that?" And I go, "Well, it's fairly, it's easy to figure out, but you just have to slowly walk through the steps." And I said, "So you have to figure out, like, how many shares of this ETF do you usually trade, and how much it moves, like intraday. Like, how much does it move today? Just to give you an example."
SSO is up 25 cents.
25 cents. So on 100 shares, you'd be up $25, and on 200 shares, you'd be up $50, right? Right now. If you
Yep.
bought 200 shares, you'd be up $50. And then if you look at the micro S&Ps, right? They're up, let's
15.
just call it 15. So that's what they're up right now. So 15 on one contract, okay, would be $75.
No, $750 on one contract. It's $50. It's $750.
It's MES.
Oh, MES. Sorry,
Yeah.
$75.
$75. So
Sorry, yes.
So that's basically how you look at it. So one MES contract would be very close to the equivalent of 200 shares of this particular leverage ETF. And that's the easiest way to look at it. You can look at, there's a lot of different ways you can do it. You can actually do the math and multiply it out however you want, but you can just look at kind of the P&L. And this is very close to 1-to-1. I mean, you can, if you're doing more very close to 200 shares of stock to one MES contract, but you can even tighten it up a little bit more depending on, how much you like to trade. Now, that said, your question here is, that's how we figure out the ratio. But the question is, can I buy a far-dated MES future? And the answer is no, not really. That's not the way you want to do this. If you want to replace a leveraged ETF with a futures contract, you're going to, assuming you would hold the leveraged ETF all year long, you're then going to have to roll the futures contract 4 times over the course of the year. It's not a big deal. It's a single click. It takes literally a second. And carrying a futures contract is just the cost of holding the stock minus the dividends you would be paid. So there's no premium involved in this, and there's no drag like there is in the leveraged ETF. So it's actually super simple to do, and you do it on the second Friday of each quarter, March, June, Sep, and Dece, if you want to roll forward. So it's super simple, and it's so much more capital efficient to just carry that one MES future. And honestly, that's it. Other than that, they're the exact same.
Okay.
And the answer, just in case anybody is wondering, for something like the MES, if you're trading the March, Sep, June, Dece contracts, which are the expiration cycles, they do settle to cash. Whereas, actually, what does the MES? I'm not even sure what the MES on the off cycle. It's got to go back into a future. But anyway, it does settle to cash if that's what you're looking to do.
Yeah, they all yeah.
Yeah. But I agree with Tom.
There are no off cycles, Scott. It's only quarterly for the future.
For the future.
The options are monthly. But
Options,
the futures
correct.
Are, yeah.
Sorry, correct.
Okay, the dropout says, you mentioned the other day, make the spread wider and increase buying power. How could I increase buying power?
Making the spread wider.
No. They're thinking of it backwards. I think they're asking, how do I get more buying power? Tom, what you're saying is you're using more buying power. You don't increase the number of you don't increase the number of contracts. You increase if you widen it out, the cost of putting that trade on, assuming you're selling it, goes up.
Yeah, so exactly like they said here. You mentioned the other day.
I understand it, but the way I guarantee you, this person is asking, how do I increase my buying power? If I have 25,000 in buying power right now, how do I get 50?
Yeah,
you don't.
I'm with Scott.
Yeah, you don't. You can't
you
increase.
don't. The answer is you
Correct.
don't.
No, you don't increase the amount of money that you have to spend.
Correct.
Yeah, exactly.
You increase the
You
buying
don't
power.
increase your buying
The
power.
way I said it is, what you do is you make the spread wider and you increase the amount of buying power that you're using.
Right, but they're okay. They're asking. They think there was a trick, so that instead of having
No, there's no trick.
Yeah, no.
Right.
No, it's
Correct.
just a misunderstanding. You're increasing, by widening the spread, you're increasing the amount of buying power that you're using. And the reason we talked about this is because what that does for you is that's your first step in learning how to scale. That's all that is. You're learning how to scale.
Okay, let's take a call. Loki
A call.
from New Jersey. Hi.
Loki, what's
Hi,
up?
Tom. Hi, Scott. So,
Hey, Loki.
Hi.
yeah, hi. Calling back again. I think I'm getting a whole, I'm able to reach out to you guys more frequently here rather than on the Tasty. So I'm using that. So I have a question related 401k. So I have like 2-3 questions. So first is, should I max out my 401k or it's better to stop after employer match? What's your take?
I think it's better to stop.
Okay.
It would depend
Now, the
on
second
what
one.
your available. To me, it would depend on what your available cash was, but it could go either way.
What's the second one?
Yeah, and second one, should I do Roth or should I do traditional?
Well, if you're stopping, then aren't you a little late to that party?
Right.
When you say stopping means,
Well, you said if you're not going to do a 401k because I assumed that you were saying because you're getting close to stopping working.
no. I think I
Oh.
want to clarify. Like my question was like, should I max out my contribution or should I just do bare minimum to get the employer match? So I'm not stopping. I'm not stopping.
Well,
Yeah.
I mean, again, that's up to your cash needs. For those that don't know the difference between a traditional and a Roth, a traditional goes in pre-tax dollars, and then you pay tax, assuming you're going to lower tax level when you take it out. A Roth goes in after tax dollars, and it grows tax free. Loki, that's up. I mean, that's up to you. I mean, I think it's kind of this. Do you want to have the government as your partner, or do you want to pay your taxes and have the money all for you? That's how I'd look at it.
And I think the question between the 401k, just putting however much your employer matches, and then if you have leftover money, put it in an IRA.
Can you
that
do
you
both?
can trade. I
Wait a
think you
minute, I
can.
don't- you can do a 401k match?
I'm a highly paid individual, so I can't do the like, IRA.
Yeah, I don't think you can.
I
What's
think
your
you
last
can.
question, Loki?
Yeah. So the last question is like, again, as Sol mentioned, like, do I just stop when the employer match is there, or should I do it options with that leftover cash, which I'm not contributing to max out, or should I do SIP just to be bare minimum? Like, which one you will prefer? I know, like, Scott is giving like a regular answers, like, okay, my situation, but if I have like enough cash to run my day-to-day or month-to-month expenses, cash is not a problem, but I'm looking for best answer, like how one should do, and not only for me, like who don't have any problem with like the day-to-day activities and like the cash usage.
Yeah.
What's the best optimal you guys suggest?
Or do you just trade your money in a regular account?
In a regular,
I mean, I
Your
prefer.
trading margin account.
I mean, honestly, Loki, I prefer a regular margin account. I don't like. I do trade in my IRA, but I trade a lot less than in my regular account. In fact, I do mostly all my trading in my regular account. The IRA, I just put stuff on, and I improve basis and stuff like that. But I kind of forget about it. I'm not that diligent with my IRA. I got to tell you.
Yeah.
I mean, I'm so caught up with all the other stuff that I kind of let that. I prefer a regular account is my answer.
Okay.
Yeah.
Okay.
That makes sense.
All right, man.
Right,
Thanks.
Loki?
Thank you.
Thank you.
Thanks, Loki.
All right.
Thanks.
Bye.
Appreciate it.
Have a good day.
Bye.
All right. Let's move on to the next one. If you hit your annual goal within the first 2 months of the year, do you continue with the mechanics for the remainder of the year, or do you tend to put on the brakes? We get similar questions like these all the time.
I mean, to be fair, there's nobody that this question drives me nuts. It drives me crazy. In what world, if you hit,
Do you want to stop making money?
yeah, right.
Do you take
Right,
Reggie
it's like the
Jackson out of
tax
the
question.
game after Reggie Jackson's 3 for 3 on home runs? Do you take him out of the game?
Right.
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 Exactly.
Like, there's no chance you're going to hit another home run.
Right. Like
Right.
it's the most insane question in the world.
I think it's too cautious.
Yeah.
Don't get it at all.
Yeah, there's no way we ever stop, no matter what. Like, it's ridiculous. Like, no, we continue on. I don't even think about things like that in those terms, ever.
I think that might be someone who's driven by fear,
Maybe not. They're just not used.
like
whatever.
averse to
Well,
risk.
but I'm not sure it's fear. I think it's just saying, look, if I'm trying to make X and I made X in 2 months, why don't I stop? Because that's what I was trying to make. And, my
Right.
answer is, but what if you lost money in the beginning? Are you going to stop? And if you're making money, why can't you make 2, 3, 4X?
Now, I do
wouldn't
feel differently,
change. The
but-
one thing for sure don't do, for sure, do not change your size. Don't change your approach.
Right.
That's just asking for disaster. So stay the course, keep doing what you're doing, and
Don't
keep
do
doing it.
4,000 puts.
It's obviously worked really well for a month or two, so why can't it keep working really well for the next 10 or 11?
Now, I do have a different approach if I'm sitting at a blackjack table in Las Vegas.
Oh, right.
I absolutely will walk away. Or if I'm playing craps, or if I'm,
Yeah, but come on,
Well,
that's
right,
different.
because that's random.
I understand, but
Yeah.
I'm saying if I'm sitting there, we're playing baccarat or pie
yes, but-
and we're up like, okay, we made a couple grand, let's get out of here. That is a completely normal thing.
That's
We made our
gambling.
number, let's get the hell out of here.
Yeah, that's gambling.
But that is a completely different world.
Yeah,
Yeah.
right. Okay, so question from the dog pound. Do some type of underlines always have put or call skew, i.e. individual stocks versus ETFs versus indices versus futures? Is it really just influenced by institutions hedging their positions? See, I said indices.
Do some type of underlyings actually have put or call skew? I mean, the answer is yeah. I mean, like, I'm not even sure. Maybe I'm not understanding
No,
the
what
question.
they're saying is, do they always have it? Like, is there always
Right.
one way? And, the answer is it can change at any time.
Oh yeah, I've seen indexes in ETFs with call skew, even though they mostly always have put skew, and I've seen individual stocks with put skew, and and I would say 90% of the time they have call skew.
Yeah,
So
I think that's the question.
yeah, then if that is the question, first of all, everything's influenced by all the money flow. I wouldn't say they're influenced by institutions or hedge funds or prop traders any
Right.
more than they are by retail. But because all the money trades the same way, there's nothing different there. But about 15% of the time, things are always the opposite of what you think they're going to be. That's what keeps everybody honest on everything in the world of finance. That's why these markets are so tight. But it's about 15% of the time, things are that you think are supposed to be a certain way are not that way. So if you want the percentage, that's kind of where it lives.
Got it.
Like for example, 15% of the time, when volatility when volatility goes higher, the market also goes higher. Or when volatility goes lower, the market also goes lower, even though they have a almost perfect inverse relationship. So that's the kind of thing. Same thing with skew.
Okay. Let's take Charlie from New Jersey. Hi, Charlie.
Hello. My question is for Tom and Scott, rather.
Sure. What's up?
I currently trade puts, and I'm averaging about 20% yearly. Would you say that that's a better tactic than trading spreads, or would spreads do better than 20%?
So
with the same amount of capital.
You're just selling puts.
You're just selling naked puts, right? You're making 20%. That's what you're asking.
Yes.
Well, as long as the market continues to treat you well and we go higher, you're a bull market genius, dude.
So the big difference is going to be, obviously, to make that kind of money, you're going to need to do bigger size if you're going to go into spreads. And the good news about a spread, to Tom's point, is if we break, you have defined risk, versus if you're just selling naked puts, you obviously know what your break even is and where you're going to be getting along the stock. But to Tom's point, you're a bull market genius. 20% is amazing.
Hey, Charlie, you know what? I personally much prefer naked puts over spreads.
Yeah,
much
me
prefer.
too.
Like, it's not even, for us, it's not even close. I mean, we will sell put spreads, but we much prefer to sell call spreads than put spreads, because put spreads generally trade cheap. So I prefer naked puts trade expensive, put spreads trade cheap. So I much prefer to sell naked puts than put spreads.
But you have to understand that you don't have defined risk.
Yeah,
So,
of
but I
course.
agree.
Yeah, we're both
Okay.
naked put sellers, for sure.
All right. Thanks.
Greatest trade over the last 20 years is selling puts. Puts are schmutz.
Puts are
All right.
There you go, man. Take care.
Thanks, Charlie.
Thanks,
Thank you.
Charlie.
No, that was one we haven't done. We missed it.
Did you
Yep.
move?
Yeah.
Stop moving it. Okay. Let's say your trading account was now 70 to 80% of your net lick. Would you still trade with as much risk as you're using, or would you change? If you would change, what would you do differently?
So the genesis behind this question was somebody said, okay, well, you guys have accumulated some wealth in your lifetime, so you're not trading with 70 to 80% of your net lick like other people are. And when he said net lick, he really means net worth, okay?
Yeah.
And so you're not trading with 70, 80% of your net worth. So, what would you do differently if you were trading with that? And I mean, to be fair, there's been plenty of times in my career where I've been trading what I felt like was all my net worth, especially for the first, 10 years of my career or something. Who knows? I mean, 40 years in, I'm not going to be trading with 70 to 80% of my net lick. But I will tell you that Scott and I do a lot of things, make a lot of investments in businesses that we are part of, not just trading, but where we will risk a lot of money. We've rolled the dice many times in 40 years with a lot of our capital. And so that's not, those numbers are not ridiculous to us.
I mean, when we started Thinkorswim, I was all in.
I was all in.
Yeah. So
Yeah.
it was like, look, if that didn't work, it did, fortunately, but if it didn't work,
Back to the
we
drawing
were
board.
we were going back to the drawing board and saying, what are we going to do? So, The answer is it's rough if you're looking at this going, okay, I'm laying it all on the line. But if you trust yourself, you believe in yourself, you believe in the process, go ahead and do it. And hopefully it works out. But again, as Tom said, as time goes on and hopefully you do accumulate some wealth, then you're obviously going to shift that number because you don't need to put 70 to 80% on the line.
You know what's weird is that I never in my entire career have looked at anything we've done and said, what if we go out of business?
Oh, well, I completely agree with you, except for the Google issue.
I didn't even then, I was like, I never worried about.
I'll say, in hindsight, I looked at that in hindsight. I didn't think about it as it was happening, but I looked in hindsight.
But I mean,
and said,
I'm just saying, every time we've done something, I never said, oh man, what are we going to do if we go out of business? I mean,
because that's a horrible way to go into something. But,
Right.
I remember my wife asking me in the early days of Thinkorswim, she's like, are you good? And, we were working our asses off. We weren't getting paid. And we had basically everything we owned was in the business. And she's like, are you good? I said, well, I don't know. I'm having fun. Yeah, I said, I'll tell you later. I'm having fun.
Hope so.
I'm enjoying it. I think we're doing something that's going to be significant, but you don't know.
I remember my wife saying, what's wrong with you? You guys, this is stupid. What's wrong with you guys? I'm like, I can't listen. I don't want to, I didn't care. I really didn't care. I didn't listen to a word. And I'm like, never thought about it.
Yeah.
You can't ever think about it. So, but
I think we're probably in a small group. It's unusual to be able to do that, but it's the mindset. And I think part of that was the mindset that we developed coming out of the trading pit. So or maybe it's the mindset that we had that allowed us to be in the trading pit in the first place, but whatever.
So
Just
this person asks, would you still trade with as much risk if you were using 70 to 80% of your net lig? And I guess my answer to that would be, when I was younger, I didn't think about it that way. So yes, in fact, it probably took way more risk than I should have, but I didn't realize. I didn't really understand it. And in today's world, we changed. And I think we would do things differently, but it's different when you're 60 than when you're 20.
Right.
To be fair, it's a little different.
A lot different.
Sure.
Yeah.
Okay, let's take another call.
Okay, great.
Steve from Miami. Hi, Steve.
Hey, Steve.
Hey, Steve.
Hey guys. I'm actually in Vermont right now, so it's not quite like Miami.
Oh, cool.
Is there any
snow in Vermont?
Any snow in Vermont?
snow.
Oh,
Yeah, is there?
yeah. No, I'm looking at piles of snow everywhere. The state is full of snow. It's beautiful, and it's sunny today, so it's gorgeous.
Oh, nice.
Nice, because there's no snow anywhere else in America, so you might as well get lucky to get some snow in Vermont.
Yeah, well, maybe it's our turn this year because sometimes the last few years we don't get as much as we used to, like in the 90s. So, yeah, we'll take it.
Yeah. All right. What's up?
Anyway, so I was listening and thinking about your discussion, the two of you, your debate the other day on Friday about politicians, elected officials, trading. And while, Tom, I've heard you say for many years this point of view, and I think there's a lot of good points that's valid. Unfortunately, I think Scott's skepticism represents a lot of people, and I think you also had a slide that said something like 84% of the public would not be comfortable with elected officials trading. Is that about right?
I think that's accurate. Yep.
Steve, let me ask you real quickly.
Okay.
Have you checked out our Unleashed episode on just this very topic?
That's what he's saying he's watching.
Yes? Not
That's what he watched on
Okay,
Friday. That's
so
what
not
he
the
said.
show.
Yeah.
Okay, great.
But keep going, Steve.
Perfect.
Keep
Sorry
going.
to interrupt. Go ahead.
That's fine. So I was thinking, obviously you both have good points. Tom, obviously you have very good points, but has been unproven because we've never tested it.
Yep.
And Scott's point is, which, it's obviously fraught with dangers. What I haven't heard, and I think is common these days in America, is just somebody coming in and saying, well, can we find a compromise? Can we come up with an idea that we could kind of test? And then, 5 years, 10 years down the road, let's look at it. Does it need to be tweaked? And that was a missing part of the conversation. So, just as a beginning brainstorm idea, what about if you say that you still can't provide insider information, that doesn't change, but people trade. Officials can trade, but they can't trade, let's say, anything within any committee they're on. If they're on a defense committee, it can't be anything associated with defense, health and human services, nothing with, let's say, pharmaceuticals. But to at least say, is there a benefit? What are the pros and cons? Can it be regulated and have oversight so it's not taken advantage of, and then move ahead? And now I realize this is falling on everybody who would either agree with me, but nobody who's actually running for office. So it's almost a little.
It's just a difficult. I think that the problem is that I think it's very difficult to manage that, and it's very difficult to regulate that. I think this is really going to come down to something that's very binary. I don't think there's a gray area here. It's got to be black or white. And
I agree. I think the problem.
I think that's the challenge.
Let's say Tom and I are in different committees, and I hear something, and I say, I can't do this, but you might want to do this.
Yeah, I just think it's got to be black or white.
That's insider information.
No,
that's
I understand that,
right
but
now.
The SEC is not that creative, so the SEC is they're going to either say we're changing the rule or we're not changing the rule. So I'm agreeing with Tom. It's binary, black or white. There's no gray area. Either we're enforcing it or we're not. Period.
My concern.
Well, then we're not going to move ahead with that. I mean, you might be right that that's the way it is, but if it is,
well,
just black or
I
white,
wouldn't say.
then we never
Steve,
move ahead on a lot of things.
But it's funny. I don't know that that's the case. What we are seeing right now with this administration is that they're absolutely loosening regulatory requirements. There's no issues for Congress right now, so they can keep doing what they're doing. If there was pressure on Congress, I think you might see somebody coming out and saying, well, let's just get rid of the rule. But they don't have to come out and say that because they can do whatever they want to do. I'm not going to take that off the table in the next few years, that they might change the rules. I don't know what the upside would be for somebody to initiate that conversation. Why would somebody want to come out and say, oh, I'm all in favor of just getting rid of insider trading? So.
Actually, I do hear what you guys are saying, and you're right. I did not take into account the fact is, for some reason, it slipped my mind that, yes, I guess right now elected officials can trade. There is no issue. They can trade if they want, and that's, of course, why the public is very skeptical.
Yeah.
Because it's not really being addressed, and it just gets ignored, and that perpetuates the distrust.
I think the challenge is that nobody. Here's my issue with Steve. I don't think anybody has done a good job articulating the risks of politicians not understanding why the market structure in the U.S. and just the way we have set everything up in this country leads to the amount of money flow that comes in here that drives this massive economic growth that we've seen. And I think when you look around the rest of the world and you look at all the limitations that people have put for all the same reasons that both of you guys are and everybody else out there, the 85% of the people have talked about, all those reasons are why the rest of the world is so far behind the U.S. And that's because
it's part of the reason.
It's part of the reason they don't let their politicians
trade. There's so much
trade.
Liquidity here. There's so much capital
here. But they every exchange around the world, they can't do anything. Politicians can't do a single thing. So nobody really understands what's broken. And nobody can understand why is all the money flow going to the U.S.?
Stop. You just said the politicians, let me clarify. Are you saying politicians, because they can trade in the United States, you think they're more knowledgeable about the markets?
Yes.
Bullshit.
And if they
that's bullshit. They don't know anything. You're the first person to say they don't know anything. They're only doing it.
They don't know anything, but they know
have
more.
An edge and they're making.
They
money.
know more than their counterparty in the UK. Yes.
Okay. I'm a seller of that.
No.
Because I don't think most politicians understand market structure. Period.
They know more than their counterparty.
We want them to understand. So Tom is making good points. We want them to understand. They don't
exactly.
now.
Yes, but what I'm saying is, I don't think that they're not doing research. They're not trading. They're not coming in actively trading the markets, watching tick for tick. All they're doing is they're saying, Right? So I don't think they understand market structure. Listen, I've been around the conversations with regulators and with politicians and trying to explain to them the way that the option markets work. They're like, I didn't know it did. I didn't know it did that. I mean, so I think you're giving too much credit to regulators.
You're right. They don't understand it, but they understand it better.
Okay,
than
fair.
people
better,
in other places.
But better being maybe 1% versus 0 or 5% versus 4%. So I don't think saying that they need to be able to trade so that they understand the market so they can make proper regulations, that's a reach.
If you want somebody to be a great musician, you got to give them an instrument.
Stop. You're talking both sides. You're talking both sides right now.
Nope, I'm not.
They know nothing.
No, I don't think
All right, Steve, you've created a big discussion here. Now Scott's going to be all upset at me all day. Look what you've done.
Sorry.
You're supposed to be out there. You're supposed to be out there like snowshoeing through the shoveling snow, and then I can't even say it.
Shushing through the mountain.
Snowshoeing.
Snowshoeing through the beautiful woods of Vermont. Where are you in Vermont anyway?
Vermont.
Where are you?
Right now I'm in Manchester Center. It's kind of like the southwest area. Bennington County, near Bennington College.
Oh, got it. Oh, Bennington's beautiful. I've been there.
I don't remember where I was,
Not
but it was
far from,
beautiful.
Not far from Mount Snow,
Stratton.
right? Oh, Stratton. Okay, got it.
Yeah. So, of course. I just came back with the dog. She was out there enjoying the snow. Like I said, she doesn't have this in Miami, so.
That's so nice.
Good stuff, Steve. We're going to let you go. We got to run.
We put up a
Thanks, man.
poll in the dog
Thanks,
pound,
Steve.
so go ahead and vote on this very topic. All right, so we're going to the next letter. I have always been curious about the relationship between the VIX and the S&Ps. My question is if there's a solid delta correlation between VIX futures and how much SPX moves.
That is a very good question. So we've actually done a lot of research on this over the years. And there is a relationship. It's not something I would say you can trade because it moves all over the place. But generally speaking, the way it works, like let's just take a look today. I'm just looking and see.
VIX futures up 10 cents. VIX cash is down 11 cents.
So the VIX futures is up 10. That's why I check in today because it's one of those weird days. The VIX futures is up 10 cents, and the S&P cash, the S&Ps are up 19 handles. So if their relationship was working the way it was supposed to work, the VIX future would be down today because the S&Ps are up. They have an inverse relationship. So sometimes, like I said, like 15 or 20% of the time, the S&Ps will go higher and the VIX will go higher, like today. But that's not normal.
10 cents is not, that's not a big move.
But it's not down.
Correct. Now, if you saw VIX up 50 cents or $1 with, S&Ps up 17, 18, that to me might be indicating, the markets are saying they're not really believing the rally.
Yeah, so
just conversely, if the market's selling off hard and the VIX is not moving, probably not believing the sell-off.
So we did a lot of research on this over the years, and the the crazy answer is that a 10% move in /VX. Okay, a 10% move. So now it depends where /VX is, but with it at like 17 right here or something like that.
It's 18. /VX is 1840. So up
Right.
a buck 80 or down a buck 80.
Or up a buck 80 or down a buck 80 and that kind of thing is somewhere around a 2% move in the S&Ps.
Right.
That's what it's predicting.
That's generally what it's very hard to measure. What we used to say was that a 10-cent move in the VIX like today is usually good for a 10-handle, 15-handle move in the S&Ps. So
And the S&Ps have had a 36-point range today.
well, but I'm saying in one direction. So the VIX is in a day like today where when the S&Ps are up right now 14 handles, the VIX should be down like 14 cents. But it's not working exactly that way. But usually when you get a bigger move...
Is there a number we can call to get that fixed?
I don't think so. But usually if you get a big move, like you get a 10% move in the VIX, you usually get something like a 2% move in the S&Ps, just as a baseline. That means 120 points in the S&Ps. So if the VIX was up, up 180 today, the S&Ps would be down probably, 100, 120. And the other way, and the other flip side to that is...
And that was the other day when they sold off.
Yeah.
That was pretty much about what the number was.
Yeah. But, listen, this is less than an exact science, and it's almost impossible to hedge the VIX with the S&Ps, and vice versa, hedge the S&Ps with the VIX. Almost impossible.
All right, I'm going to spin this to make you feel good about the dog pound. Mm-hmm. I'm going to spin this and give you the other number. 28% of the dog pound agrees with Tom there should be less restrictions.
That's really big. That means I'm making progress.
Okay.
Because that number used to be about
72% believe there should be more restrictions. So I was giving you the upside to that and saying 28% are agreeing with you.
I mean, usually I'm a contrarian, so I'm playing the role of contrarian now. Occasionally I'll be public because according to Jules, betting on Seattle was public.
Your 3 bets that you're an idiot for all 3 bets that you won.
So occasionally I'll go public, but normally I'm pretty hardcore contrarian. So I'll take my 28%.
Okay.
So talking about contrarian, because I'm absolutely contrarian as well. Do you think we had that prior to being on the floor, or do you think that evolved?
Oh, I was a contrarian. I was born a contrarian. I've been an annoying contrarian since early on, since birth.
Like, give me an example,
Your
if
poor
you
mother.
would. Like, as a kid, I was difficult. I mean, I was when I say problem child, not a huge problem child. I wasn't in prison, but when my family had to have an intervention without me about what to do with me, I don't know. I guess maybe that was being a contrarian. But what would be an example for you?
For me, an example would be that I was always willing, even from a young age, to take the other side of any of my friends' bets, because I knew that they were losers, and I would.
Hey, I hope Kenny Rubenstein's not paying attention to this video.
Oh, I'm sure he is, and it started early.
Kenny, no hate, no shade. Go ahead.
Because I started playing golf for money when I was like 13 or 14 years
Rocco.
old, and everything we did was like I took the other side of everything. So,
maybe Rocco did this to you.
Could have been Jimmy Rocco.
Yeah, Mr. Rocco.
Could have been.
Yeah, how much do you got in your pocket? I'm taking it all.
That's right.
And then the rest of us paid the price for that for the next 30 years.
40 years.
40 years.
Yeah. Sol pays the price every day. She's got to sit next to me.
Every day.
Ugh. That's awesome.
All right, next letter. Last one before we do market talk.
Okay.
Hi. I wanted to say thanks for all the platform capabilities, industry standards, and educational content you've provided over the years for retail traders. I'm excited to see what Lossdog will become. Question.
Nice.
You've said in the past that disciplined, dedicated, smart people often fail to become successful traders. In your experience, what's the most common reason why that happens? And do they ever fix it and turn things around? Justin. Thanks, Justin, for the kind words.
Yeah, thanks, Justin.
God, people remember what I say better than I remember what I said. I mean, I have said, I've said that a lot of...
Yeah, you said it last week, I think.
There's an incredible range of successful people and successful traders that I have met over the years. And I could never figure any of it out. Like sometimes we would hire, half the guys that I knew over the years. Half of these guys couldn't be lucky to get out of high school. Other people we'd hire.
We were just talking, I'm not going to say his name, but we were just talking about somebody that I haven't seen in 20 plus years. You just saw him yesterday. He was one of the best traders that I ever saw. And I don't think he graduated high school. He was a bag boy at Treasure Island, which was a grocery store in Chicago.
I've seen people that, like Scott said, never graduated high school, never went to college.
How about Sue Harrison? She was one of the only women in the OEX pit. She came in a dress and high heels.
I don't know what her deal was. I don't know if she went to high school.
She didn't graduate high school.
I don't know. I don't know what other people did, but my point is there was lots of really successful traders that were kind of like just incredibly street smart.
Right.
And they were just made for like the alpha kind of mind, and
Yeah.
they were undisciplined. They were not dedicated. they were probably smart, but street smart.
Right.
And there were others. We hired a PhD who failed. We hired multiple MBAs from really good institutions that failed, and that just weren't strong enough in that environment. They might have been hugely successful in other things they did in life.
Right.
But so there was no way to tell, I guess is my point. And
There's no simple test to say
there is no
that
simple
this,
test.
Right.
Met kids that were so disciplined, dedicated,
So what could
smart.
be the most common reason you think
That-
they would fail? Smart people fail.
Okay, so sometimes the trading world is just not for everybody. I'll give you an example in the golf world, just because we talked about golf a second. I once was playing golf with this assistant pro at some golf course, and he was really good. Obviously, he's assistant pro, but I beat him because he hates gambling. He literally hated gambling. He got so nervous because we were playing for a lot of money that it messed up his head and he couldn't play.
Yeah.
And I was kind of like, enjoyed the money part. And obviously he was a way better golfer than me, but I beat him because I didn't care about the money and he
He was
did.
so
I think that's a
nervous,
really
he
good
hated
point.
gambling.
So
Yeah.
first rule of gambling, and I'm not saying trading is gambling, but the first rule of gambling, if you're playing against somebody, is get them to play for more than they want to
Than
play
they're
for, because
comfortable
then
with.
they're thinking about the money. And
Well,
they're
I
not
don't
thinking
even
about
think it was
the actual-
like the actual amount of money. I just think that it was.
He probably wasn't used to playing for
Just the
money.
circumstances.
So here you could see people walk into a pit. I think it's a good point, and they just aren't comfortable. They're like, "Oh my God, what if I make a losing trade?" You're gonna make a lot of losing trades. It's just hopefully you make a lot of winning trades.
Or like
along
the friend that you said who
Hey,
just
I'm gonna tell you,
decided
I'm gonna
who's
tell you-
super smart, but then
Yeah.
decided to really go on the deep end risk-wise.
Yeah, forget about that. Forget about
Just
that.
doesn't work.
Forget about that assistant pro. I got a better story. So,
Okay.
so my wife and I were on vacation once. This is a long time ago. We went to Puerto Rico, some resort. I don't even remember. We were younger, and I brought golf clubs because it had like a golf course attached to it. I don't even know why I brought golf clubs. Anyway, so I had nobody to
Bring
play.
the glove to the Cubs game. Anyway, go
I
ahead.
had nobody to play golf with, so I go to the first tee. I go to the pro shop and I go to the first tee, and they set me up with some random person, right? And I'm used to playing with Scott and all my friends, and we play for money. It's just natural. But I've never really played with anybody when we didn't play for money, like for something, $10, $20. I didn't even care what it was. So I go to the first tee, and this random guy, and they paired us up. We said, "Hi, we're sharing a card." And I go, "You want to play? What's your handicap?" He goes, like, let's say 18. I don't know. And I go, "You want to play a little game?" And he goes, "What do you mean?" I go, "Yeah, we'll play like a $50 Nassau or something, like just a little game, or $20." I don't even remember what I said. And he goes, "Well, I don't really gamble, but sure, let's do it." And I gave him like a very fair handicap for me. Scott's gonna say, "You did not,"
Yeah,
but I
I'm sure
did.
you did. I can
All
see
those
the
people
lies
listening
coming
right
out
now,
of his mouth as he's saying
A fair
it.
handicap for Tom is one
I
where
know
he
he's
wins.
lying.
So I gave him a really fair handicap. Anyway, so we go to the first tee and we play the first hole, right? And the guy is like, whatever he said his handicap was, he's horrible. All right. I mean, he said he was 18, but he's like, in
13.
our world, he'd been a 36. All right, but whatever.
Oh, sorry.
So
the other way.
So I win the first hole. Then we play the second hole, and he's all in the woods. He's picking up basically. So I win the second hole. He goes, "I can't play with you. I have to go in." He goes, "Because this money thing has got me all messed up." I go, "Then we don't have to play for money. Okay, don't worry. I was just trying to make it fun." He's like, "No, I can't play with you." And he
Aw.
left.
See what you
So-
did?
I didn't even. I just was trying to make it
Ruining
interesting.
people's
I
experience.
was trying to make a
That's
friend.
what Tom's good
on
at.
the
So
rag.
I'll say, so when you start doing something for more than you're comfortable doing, that's the whole thing. Then
Well,
your
some people
question
just
is
aren't
like,
comfortable with risk on any level.
Okay, Michael
Yes,
Jordan.
but-
We're playing cards with Michael
Oh,
Jordan.
don't name drop.
Oh
I
my,
gotta say
yes,
it.
please, Michael
But he
Jordan. Any
takes
story
the
about
cards.
Michael
We're
Jordan
playing-
warms my heart and makes my day.
We're
He's a
playing
name dropper.
gut. So like you're in or you're not, and you go 1, 2, 3, drop, and then you're in or you're not. He puts the cards in his pocket, meaning there's no 1, 2, 3. He's just in. So now you have to make a decision, and it's like, well, I don't want to lose whatever's in that pot. I can't, but
Right.
you have no idea what he has.
Yeah.
So, so you have absolutely no chance of competing in that world.
Right. All right, let's take our last call. Steve from Utah. Hi, Steve.
Hi, everybody. Quick question. The rule of the investment, good practice in crypto, consider the volatility of the crypto. What would be what percentage of the portfolio should be in the crypto?
1, 2, 3, or 4, depending on how much money. We did a lot of studies on this, Steve, in the past, and I mean, again, this all depends. Like if you were my son right now, and you ask that question, he's going to tell me it should be 50 to 60%, because that's just the way kids. He's in his early 30s. That's the way kids think. And if you're in your 20s, you might say 80% or something like that. I don't know, maybe, but I think
my son is 31 and 100% is in crypto.
Yeah,
he
sure.
doesn't care anything else.
Yeah, well, my son is 60% in crypto. He's just like your son. So that's typical for that age. But if you're your age or my age, Scott's age, Sol's age, whatever it is, we've done a lot of work on this. I would not go higher than 5%. I think 1, 2, 3, 4, or max 5. Right now, I'm sitting a little below 2.
I see. We are both graduates from SUNY. I'm from SUNY Stony Brook, and you from SUNY Albany.
That's right. fellow SUNYian. Yes.
Speaking of colleges, I got to give a shout out. Miami of Ohio is the only remaining undefeated team in college basketball.
Ooh.
What does that have to do? We're talking SUNY here.
Nice.
All right, Steve, what
I
else
went
you
to
got?
Miami, so I'm giving a shout out to my school.
Yeah,
Second
quick.
question. The rule of 110 is still has efficacy, which means you subtract from your age and see how much stock and how much bond is going to be, or this rule
Age minus
has been changed?
110.
I have no clue. That's
Never heard of that. How, but if you have age minus
Age
110,
minus
it's going to be a
110.
negative.
No,
Right.
but still,
How is that?
I don't even know.
You're not that old.
Is it the other way around, maybe?
Anyway,
110
Steve,
minus your age?
with those rules like 60-40 or whatever it is,
Right.
I don't pay attention to that anymore. None of us do.
Okay.
Those are all
110
long gone.
minus your
It's just
age.
very subjective. In other words, it depends on
yeah.
what people think.
Yeah.
Thank you. Have a wonderful day,
take care.
everybody.
Thank
Bye
you.
now.
You
Thanks.
too.
Goodbye.
Hi. All right, let's do market talk.
All right, let's do it.
Everybody's waiting for market talk.
All right, Bitcoin back under 70,000, 69.3 down 1,600. Oil 64. SPOOs have been moving around a little bit. They're up 12, 6,994. They've been over 7,000. Gold down 41. Nasdaq up 33. Silver 80, about 80 and a half, down $1.60. VIX cash up a little bit.
Can I say one
28
thing about silver and gold today? Because I think it's interesting if you have positions on in there. Today, finally, somebody woke up, put on the light, and decided we are going to literally annihilate premium. They haven't taken premium out of gold or silver in the last 3 weeks. Today is the day they decided to do it. I think they took, I don't know, it seems like they took 10 or 20 ball points out today. Finally.
ETH is a little over 2,000, 2018 movers. You got Meta down 6, Microsoft up 8.5, Moo down almost 12, Netflix catching a little bit up 2, Oracle catching a little bit up 7, and Reddit, which again you can't trade, which is unfortunate because that's not got annihilated. That's up 9 today.
Yeah, Oracle's had a nice bounce the last couple of days after being in the.
What did it get in the 140s or 30s?
I think it got under 140, but I'm not 100%
Yeah,
sure.
it got to 135.
Yeah, they just crushed it. Yeah, we've been long a little Oracle, which is good.
It's got 100 IVR.
Yeah, I'm playing a little Hood today for earnings after the close.
Oh, what's the expected move? Hood is up 70 cents at $87.
It was down about 70 cents this morning, which was nice.
Expected move today is $8.
Yeah, I'm a little. I'm short a bunch of puts in there. I'm fingers crossed. I liked it better at 70, 72 or 75 than 85, but I sold a bunch of puts in there, so we'll see what happens. That's the only earnings play I'm playing today.
Nice.
So we'll see.
We'll see.
All right.
Crossing fingers and toes.
Let's go.
I love the comments on the dog pound. I really love how everybody is so funny. They say Jedi mind tricks are key in the golf course.
Of course. How do you
Jedi
think-
mind tricks.
You know what I've been doing to Scott over the years?
And Tom, Margin called him.
What?
Margin called the guy.
Oh, for sure. For sure.
What were you to say?
Nothing.
All right. Well, don't forget to like this video, subscribe to our channel, send us your email questions to oneluckydog@lossdog.com, and call us, leave us a voicemail, 989-LOST-DOG. And that's it for now.
Happy Tuesday. Thank you.
Happy Tuesday. Bye.